It's been an interesting quarter with a number of key developments really driving markets. First of all, at a global level, the trade tensions that we're seeing between the US and China, that's really sort of driven markets up and down depending on what the potential outcome is going to be. And secondly, we saw President Trump going to North Korea, and those discussions there have also driven sort of risk sentiment in markets. At a regional level, the US continues to be in focus. We've seen the US central bank there continue to raise rates, and it looks like they will continue to raise rates over the course of the next year and a bit. And that really reflects the US economy firing on all cylinders. That's quite distinct from what we're seeing here in Australia, where the RBA looks like they'll be on hold for the foreseeable future. In Europe, developments there saw an Italian election where the anti-establishment parties are beginning to rise to power, and that's sort of really driven risk sentiment there, seeing markets sell off quite aggressively. And secondly, late in the quarter, we saw the ECB announce that they will start to reduce the amount of buying that they've been putting into the markets in recent years, but also indicated that sort of they won't be raising interest rates as quickly as had been first expected. So what that's all meant for markets is that the US had a particularly good quarter, and if you look at the segments of that market that did well, it was really growth stocks. Australia too had a good quarter, although financial stocks on the back of the Royal Commission here didn't do as well. Conversely, emerging markets have had a pretty difficult quarter, and that really reflects the difficulties that we've seen more broadly, but also a number of country-specific events in Argentina, Brazil and Mexico. The portfolios have had a more difficult quarter this quarter, and that really reflects the outcomes that we've seen in the different parts of the market. Our portfolios continue to be focused away from Australia and the US market, and that really reflects the extreme valuations that we're seeing in both those markets. We can continue to favour the emerging markets, and given they had a relatively poor quarter relative to Australia and the US, our portfolios haven't kept up as well as other developed markets. Elsewhere, other parts of the portfolio that have done well have been Japan and our positions in US healthcare. But the elevated cash positions that we hold in the portfolio have been a continued drag as the RBA continues to keep the cash rate at a record low of 1.5%. Although the performance of the portfolios hasn't been where we wanted to be in the short term, we remain as confident as ever that the portfolios are in good shape to deliver on their longer term objectives. Quite often, shorter term performance doesn't drive longer term outcomes, and we think that sort of the valuation differentials that we've seen between markets like emerging markets, for instance, versus Australia and the US, will mean that sort of we can generate value over the longer term from these emerging market positions. We've seen this before. Quite often sort of we see the bad before we see the good, and as contrarian investors we need to expect that. So we think that sort of as we look forward, that the portfolios will be able to sort of retrace some of this shorter term relative performance and deliver over the longer term. We look to positions that we've held in the portfolio previously, like Japan and Australian REITs, where we saw some tough times before we really saw the value of those positions come out.
Any advice in this video is general advice prepared by Morningstar without reference to your objectives, financial situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.